to all the members and participants of All Gujarat Federation of Tax Consultants and Income Tax Bar Association in this last webinar of Direct Tax Law Committee and last webinar of this activity year 2021-22 for AGFTC. Friends, today's topic, webinar topic, is very important because now in this faceless era, we are going to face many litigations and we have to be prepared for presenting our submissions in a proper manner in this litigation. Friends, to know decisions of ITAT is very important because ITAT is the last fact-finding authority, and then only your case travels to High Court if it is a question of law. So in a way, it's a final authority who will decide your case depends on the facts. So friends, we must know the recent decisions of ITAT so that it can help us in scrutiny level and on CIT appeals level. Friends, today we have invited none other than expert in direct tax law, and he is actively engaged in ITAT practice day in, day out. Please welcome the Honorable Speaker, CA Aseem Thakkar. Sir has consented to AGFTC and ITB against all odds. One of his near relative is hospitalized, but still sir has given us the consent. I really appreciate, sir, for your kind gesture.
Thank you.
With these words, I request Chairman of Direct Tax Law Committee, CA Bakulai Shah, for his opening remark.
President, members of our managing committee, as well as all the friends, I am very much thankful to you for successfully participating in our direct taxes, webinars, etc. We have, during the year, we have completed 10 webinars, which includes 3 webinars on budget session, as well as 4 representation. This is the 11th webinar on direct taxes, and this is the last one because the year is now completing. I am very much thankful to Aseem Bhai for his quick consent to participate in this our webinar and to enlighten the members for the recent judicial decisions of the tribunal. I am once again thank you all for your kind cooperation during the year. Thank you very much.
Thank you, Chairman, sir, for supporting AGFTC during the whole year for representation and for webinar. Now I request Vice President of Income Tax Bar Association, CA Ashish Tekwane, to give his brief speech.
Thank you, Kartike Bhai. Income Tax Bar Association is highly pleased to be associated in the long list of webinars which have been organized by the AGFTC, and being the treasurer in the last year and vice president in the current year, I am really obliged to all the managing committee members, subcommittee members of AGFTC, and especially the direct tax committee, indirect tax committee, and allied laws committee for giving us an opportunity to be co-participant in so many programs of different natures, from covering GST, income tax, and all other laws like RERA, arbitration, MSME subsidy, and different kind of other intellectual programs which we had. I would also like to thank the eminent speaker today for giving his consent in spite of all odds. And sir, this shows your commitment towards the profession and towards the association. Thank you so much. And over to you, President sir.
I request Honorable Treasurer of AGFTC, CA Shivam Bhavsar, to please introduce our today's expert faculty. Shivam Bhai. Mute છો તમે, unmute કરો.
It's my pleasure to introduce our today's eminent speaker, C. Aseem Thakkar, sir. Sir is managing partner of A.R. Thakkar and Company. Sir is auditor of various corporate bodies, including the listed companies and non-corporate entities. Sir is specialized in the income tax appellate tribunal. Is related to search and settlement commission. Sir was the vice president of income tax appellate tribunal bar association in Ahmedabad. Sir is also associated with number of subcommittees and managing committee with GFTC. Sir is the author of the digest IT80 decision Ahmedabad bench of book. Thank you, Karthik.
Sir, stage is yours.
Thank you, Karthik bhai. At the outset, I'm very thankful to the All Gujarat Federation of Tax Consultants and Income Tax Bar Association for inviting me to share some of my thoughts and present this paper on the recent tribunal decisions. I'm particularly thankful to Karthik bhai and Dhruvin bhai, the presidents respectively of both the associations. I had a personal difficulty on Monday. A close relative of mine had been hospitalized and was ultimately expired also. But I had made a request that if you can please cancel my event because it's not possible for me. Karthik bhai was insistent that no cancellation. We can refix and reschedule. So I'm very highly grateful for this accommodation which has been granted to me. Of late, let me tell you, this topic is not going to hold much of relevance for the simple reason that since last 2 years, CIT appeals are not being decided. Presently, the pendency in IT80, which was in for Ahmedabad benches was nearly 9,000, has only gone down to 3,600. And the primary reason is that since last 2 years, CIT appeals are not being decided, so matters are not traveling to the tribunal. So I think Karthik bhai or the incoming president, you'll have to take stock of this situation, concentrate more on the High Court and the Supreme Court decisions, because of late, since last 2 years, whatever decisions which are coming, they are very cryptic. They are usually covered matters. Nothing new and novel is being thrown up by the tribunal by way of, which can lead to some kind of a discussion or a debate. But nevertheless, this is a personal view. Coming to the topic at hand, the first decision, I have tried to sort out these decisions in terms of practical relevance in our day-to-day practice. It may not touch certain areas, more than adequate judgments I may have touched, but this is keeping in mind this objective that if we are going to practice on day-to-day basis, what are the issues which crop up? Now, if these are the issues which crop up, what is the settled position of law in this area? So that is how I have gone about. The first decision which I am referring to is Prakash Mithalal Oswal versus ITO. ITA number 327, Pune, 2019. The issue is that a survey operation had taken place in the case of an SSE on 13th September 2013. During the course of survey operations, the SSE made a disclosure of 50 lakh rupees. He surrendered that income. And immediately for 13-14, when the due date of return was coming in, he included that income and filed his return of income. The AO, while completing the assessment, said that had survey operations not taken place, this amount would have never been disclosed. And it is only on account of survey operations that you have made a disclosure, and so therefore, he accepted my returned income, but penalized me for under section 271(11)(c) for that disclosure amount of 50 lakhs. CIT also concurred with the view of the AO. When the matter traveled to the tribunal, tribunal deleted the penalty. While deleting the penalty, tribunal took view of explanation 1 to section 271(11)(c), where it says that explanation 1 would be applicable only in respect where any facts which are material to the computation of total income, these are there, and the SSE has failed to offer any explanation, or the explanation offered is found to be false or is not in a position to substantiate, resulting into an addition or a disallowance. Now, primary condition for levying the penalty as per explanation 1 is that there has to be some addition or a disallowance. In this case, since the matter had already been disclosed by the SSE, there is no addition, no disallowance being made, and therefore the question of penalty does not arise. they also distinguished explanation 5 and 5A. They said that no, there are certain circumstances where you can be penalized, but when can you, even when you have included the disclosed amount in the return income. For instance, in case of a search operation, the provisions are, I'm talking about a search prior to 1/4/2021. The provisions are that 6 years 153A notices come to be issued. Now, suppose a search took place on 27th of March 2021. So 21-22 would be the search year, and 6 years earlier they would reopen. Now, suppose they have reopened, say 1890. All these years have been opened, but during the course of search, they have come across any information that I had made an investment of say 50 lakhs in a property. There was a cash payment made, diary was found, and that matter is corroborated with other evidences. So when I've been issued with a notice, I have to file a fresh return. In that fresh return, for a completed assessment, I include my 50 lakh rupees and thereafter file the return. So here also I have included in the return, no addition will be made, but here explanation 5 and 5A clearly would apply, where it applies because there is a search. In case of a search, 5A, explanation 5 and 5A would come into play. In case of a survey or any other normal proceedings, explanation 1 would come into play. So these are the two distinctions which one has to keep in mind. Otherwise, if you make a disclosure during survey, pay your taxes, and now that return has also to be filed in time, then you would get away from the penalty. Of course, formerly we had a concept of agreed assessment, if you would recall, that during the course of assessment proceedings, you say that no, I accept, I'll pay my taxes, I pay the interest, please don't levy penalty. Supreme Court has frowned upon that practice also. So therefore, now that agreed assessment concept is also no longer there, which is available to the SSC for the purpose of escaping penalty provisions. The second decision is, which I would like to discuss, is Messrs. Poonam Builders 15/SRT/2021. In this case, once again, a survey operation had taken place and the SSC was in the business of construction. During the course of survey proceedings, books of accounts, loose papers, WhatsApp chats, and everything were found and impounded. On the basis of that impounded material, the AO reached a conclusion that SSC had taken cash in respect of certain bookings which had been made of residential units. He had calculated that the total cash receipts which was received by the SSC was to the extent of 2.57 crores. Accordingly, an addition came to be made. During the course of CIT appeals, the SSC made out a case that these were only rough papers. I had made this entire sheet indicating that what would be the possibility of me recovering cash from the members in case I sell the unit, because I was preparing this as a project report for selling the entire scheme to another builder. Apart from that, he also stated that none of this seized material which had been found even remotely indicated that any member had actually paid me any money. CIT appeal took a view that to a certain extent, the contentions of the SSC are acceptable and therefore estimated the income at 20%. The matter traveled before the tribunal. Before the tribunal, the same arguments were reiterated, but an alternative plea was made that if none of my arguments are found acceptable, then at the most what you can add is 4 to 6%, which is the net profit, and not the 20% profits which have been made on, not confirm the 20% profits which have been made on an estimated basis by the CIT. The arguments which were, the Honorable Tribunal took a view that yes, any estimation of income would involve guesswork. That is, we do not discount that possibility. Some guesswork has to be there because there has to be an estimation. It cannot be that it can be exact or a very scientific method. Some guesswork would normally be there. But however, one cannot ignore the past results of the SSC, and particularly those results which have been accepted. So you'll have to look into what were the earlier years GPNP, particularly they said NP, because indirect taxes are also a deductible expenses, and therefore net profit only should be taken into consideration, which has been accepted in the earlier years. That would be the best basis for assessment and estimation, and income should be determined accordingly. So therefore, the principle they laid down was that while estimating income, net profit should be taken, not gross. That net profit should be from your earlier years and such earlier years which have come to be accepted by the department. Ultimately, what the tribunal did was that they, from 100%, which was done by the AO, CIT scaled it down to 20, and tribunal has come down to 8%. So the principle which had been laid down was that only net profit should be taken into consideration. The third decision which I would like to discuss is Arham Pumps ITA number 206/AHD/2021. Now, this is very interesting because one can take an advantage of this decision even in case of a settled position of law against the SSE. In this case, what had happened was that the SSE filed a return of income. The return of income came to be processed by CPC Bengaluru, and they made an addition, a disallowance rather, in respect of payments which had been made for PF and ESI beyond the due dates as laid down under the specified act. So as you are well aware that Gujarat State Road Transport Corporation, Gujarat government has clearly laid down that if it is paid beyond the due date as specified under the act, you will not get a deduction, irrespective of whether the payments have been made before the due date of filing of the return of income under section 139(1). So here, you are well aware that in the intimation which comes to us under section 143(1), there are two columns only, that what is the income returned by the SSE and what is the income which has been computed. There are only two columns. There is no special column indicating or giving any information or intimating what is the disallowance, why it is being made, or so, and nothing of that sort comes. The SSE, against this intimation, filed appeal before the CIT. The CIT appeal conducted the appeal, but thereafter this matter got transferred to NFAC, and NFAC, after 2 hearings, said that nobody has appeared, passed a very elaborate order. They referred to the decision of the Gujarat High Court, both the Gujarat State Road Transport Corporation as well as Suzlon Energy, and said that this was a jurisdictional case applicable in the case of the SSE, and therefore the disallowance under section 36(5)(a) has been correctly made. The matter traveled before the tribunal. The tribunal took the view, this is Ahmedabad Tribunal's view, that for the purpose of processing the return, there are 6 adjustments which have been clearly defined. I'll just come to those adjustments and read them out briefly. First is that there has to be an arithmetical error in the return. Second is that if an incorrect claim has been made, then that can be rectified. Third is if there is any disallowance of loss, if any, in the return where the set-off was being claimed, where the return has been filed late. Similarly, in disallowance of any expenditure indicated in the audit report but not taken into account while computing the total income. Disallowance of deduction under section 10AA or any other provisions of chapter 26A, where those deductions have been claimed, where the return has been filed beyond the due date. And if there is any addition in income which appears in form 26AS or form 16A or form 16, which has not been included in computing. So these are the only 6 adjustments which have been put there. Now, it has also, then the first proviso, this is very important. The first proviso says that provided that no such adjustment shall be made unless an intimation is given to the SSE of such adjustments either in writing or in electronic mode. So the proviso, as per the proviso, there has to be an intimation which is to be given. Now, once a 143.1 return has been processed and the order has been given, intimation has been given, and there is no intimation of such adjustment other than those 6 adjustments given to me, the entire process is illegal and bad, and this process cannot be acceptable. So even though in this case, the decision was against of the jurisdictional high court was against the SSE could still get away because the processing had not been done in the correct manner. So the point which I would like to draw your attention to is that if you have any cases where similar disallowances have been made, don't file a rectification application. Straight away file an appeal. Because if you file a rectification application under section 154, the possibility of that explanation being given to you and thereafter you are succeeding in the tribunal would be greatly reduced. So this decision is of which according to me is very important, which one should keep in mind. The fourth decision which I refer to is in the case of Tenovia Solutions Private Limited. It is again a Bangalore tribunal decision, ITF number 490/Chennai/2021. As you are well aware that the due dates of returns are generally 31st July and 30th September. Everybody is busy uploading the return. The mobile is next to them. They are continuously monitoring their various WhatsApp groups. Kya re boss, return gaya nahi gaya? Mere system mein ye ho raha hai, aapke kya ho raha hai? There are technical snags, overflow of data, system crashing down, and therefore a lot of heartburn is there. In this case, what happened was that the SSE filed the return of income. The due date was 30th September. For some reason or the other, in spite of sitting 21 hours, that was his claim that I have sat for 21 hours before the system, but the system was not, it was overworked. There was a technical snag and I could not file the return. My return ultimately came to be uploaded 12 minutes and 10 seconds later. That is, on 1st of October at 12:10 in the night, my return was uploaded. So therefore, the system accepted the return on 1st 11. The return which came to be filed carried the return which came to be filed had a carry forward losses of 70 odd lakh rupees. When the return came to be processed, that losses came to be disallowed on this ground that you have filed the return on a not within your due date, though it was only 12 minutes late. It was explained that there was only a technical snag and I am not at fault. Madras High Court, in a similar case, in the case of Reagan Infrastructure and Services, 68 taxman.com 93 and further affirmed by the division bench in 75 taxman.com 135 has condoned a delay on account of technical snags of 1 day and permitted the carriage forward of the losses. So if there is a technological problem, there is a site overburden, you cannot upload the return, please take a screenshot, save it for yourself. You can use this as an evidence that this was the problem, why the return could not go, and therefore you can still get the benefit probably of the carry forward of the losses if it is correctly litigated. The next decision which I would refer to is Kundan Builders versus ACIT. ITN number 157 of Pune of 2015. So many a times we see that in a search proceeding, a search statement is recorded and on the basis of the statement, additions are coming to be made. The moot point is that merely on the basis of a statement recorded, can an addition be made? Or there has to be some other corroborative evidence which is necessary for making the addition. If I made an addition, if a bold statement has been made, but which is not supported by any material, addition cannot be made. And that is what has been held by the Pune Tribunal in this case. In this case, the facts were slightly this wise. That the SSC was in the business of construction, and they had agreed to purchase a land from one Parande family. They were subjected to search also, but they had agreed to purchase a land from one Parande family. That Parande family had cancelled this purchase agreement with them and had further agreed to sell the same land to one Kamraj Associates or Kamalraj Associates, I forget the name. The return of income had come to be filed, in which this SSC firm, Kundan Builders, had disclosed an income of rupees 20 lakhs as the amount which had been received by them on the cancellation of that Banakhat, which had been originally made. The AO, while completing the assessment, made an addition of further 21 lakh on this ground that the landowners had given a statement that they had given you cash of 21 lakhs. And on the basis of this statement, the addition came to be made. CIT appeals also did not concur. He confirmed this addition. The matter went to the tribunal. The tribunal held this wise, that during the course of search proceedings, no material has been found that the SSC is in receipt of 21 lakhs. So what now you are relying on is one assertion made by a Parande family member. Parande family member was not allowed. His cross-examination was not allowed. Subsequently, that also came to be granted. And in the cross-examination, what that Parande family member said that we have made these cash payments out of our bank withdrawals. We are a joint family. My share I have given. Other family members he identified, but he could not produce them, and neither did those people admit to having given any cash. So ultimately, what the tribunal took the view was that other than this statement, self-asserted statement of one member of the Parande family, where there is no other evidence which has been found, the additions which have come to be made do not deserve to be confirmed, and the same had come to be deleted. So therefore, mere statement by itself should not be the reason for confirming the additions. Similarly, statement should be of a person who is connected with the business. Only those persons can have, only those statements can have an evidentiary value. I'll draw your attention to the case of one Madhur Jain versus ITO, ITN number 5681/Delhi/2018, where what had happened was that the SSC was in the business of trading of utensils, steel patta, and manufacturing of steel units. The return came to be filed disclosing income, wherein in the audited accounts they have disclosed stocks of rupees 80 lakhs. The AO, while completing the assessment, had made a difference in the valuation of stock. The addition came to be made was up to the extent of rupees 22 lakhs. The reason for making this addition was that at the time of survey, the survey team, what they did was that they accepted the opening stocks, they added the purchases, they took into consideration the sales as per the books, applied 8% GP, and thereafter derived the value of the closing stocks. For the purpose of deciding what the value of the closing stock was, they took the value of 230 rupees per kg instead of lower kg 180, 190 as was generally adopted by the SSC. Now, matter traveled before the CIT. CIT also concurred with the AO, and the additions came to be confirmed. Before the tribunal, it was contended that you are accepting my opening stock, you are accepting my purchases, you are accepting my sales, you are deriving that closing stock by applying a GP percentage. Now, when all these are acceptable, then how can closing stock be not acceptable? That is ground number one. Two, you are relying on a statement of the son of the proprietor and not the proprietor. The son of the proprietor has himself stated in categorical terms that I am not regularly attending office. I have no clue about what the rates are. This is my belief that the rates are 220, 230, but the books are but that cannot be the gospel truth, because then this has to be independently verified. The statement of the SSE, that is the father on whose statement it was reliance, who was subjected to survey proceedings, had never been taken. So therefore, keeping into all this, apart from the basic fact that a statement recorded under section 133A doesn't have evidentiary value, this is also a settled position of law in the case of Kader Khan and Sons, but the Supreme Court has held that a survey statement has no evidentiary value, and the reason is simple. In a 131 statement, they take your oath is administered. So therefore, there is a sworn element in the statement. In a survey statement under 133, there is no oath taken, and therefore it doesn't have any evidentiary value. So leave alone a statement recorded in the survey operations has no evidentiary value, but the statement has been recorded of a person who's not even remotely connected to the business, though he may be the son of the proprietor, but he has no connection with the business activity, and so therefore relying on his statement, additions which have come to be made have been deleted. So the underlying principle is that the statement has to be recorded of the person who is a responsible person in the business. So therefore, any remote person's statement recorded during course of search or survey and placing the burden on the SSE to dispel all the contentions which have been made in such a statement of an irresponsible person, the additions would not survive. I will take up one decision. Mrs. Sikha Sanajya Sharma, 137 taxman.com, 214 Ahmedabad. Now, in this case, what had happened was that the SSE had filed a return of income wherein exemption had been claimed in respect of sale of shares under section 1038 of a huge amount, massive, say 15 crores. Against that, the SSE had certain long-term capital losses, but no STT had been paid, as well as there were other short-term capital losses. So what the SSE did was that he, on a standalone basis, declared the income under section 1038, which was exempted, so not coming into the tax orbit. And thereafter, those losses which had arisen in respect of those long-term capital losses where no STT had been paid, or those short-term capital losses, they were carried forward. The AO, while completing the assessment, accepted the returned income. That income on a standalone basis came to be accepted. But what they did was that he set off the losses against the income, and therefore the carry forward of the losses came to be reduced. So therefore, from against exempt income, short-term losses and long-term capital losses without without the payment of STT had come to be adjusted. The SSE filed an appeal that, no, you cannot do this because I am entitled to the complete set off of loss, carry forward of losses, and not that reduced after the adjustment against the income. The Honorable Tribunal has taken a view that Chapter 3 deals with exempt income. Section 10 is housed in Chapter 3. Chapter 4 deals with the different incomes, heads of income, and Chapter 4, it begins from Section 14 to Section 59. 14 deals with the heads of income, 15 to 59 with the manner of which computation of income has to be made under the various heads. So we have 6 heads, and all how the income has to be computed vis-a-vis each head, all those have been identified there. Only which is income which falls within 14 to from 15 to 59, they get carry forward in section 79 and 80, where there is carry forward and set off of losses. Chapter 3 doesn't come into play at all. So therefore, one cannot set off losses against exempt income, which never forms a part of your Chapter 4 income, and you can permit it. The reverse position can also apply, obviously. That if you have, here it was a case of income where the losses were down there, you may have a loss and there are incomes arising. So you cannot adjust an exempt loss asset exempt loss arising to you from an exempt source against a taxable source and adjust it. It works both the ways. And the base judgment is Kishore Bhai, Bhikha Bhai, Virani, 367 ITR 261. So this is now the next issue which I would like to discuss is in the case of Vikrant Happy Homes Private Limited, ITA number 2856, Pune 2016. Section 40A3 in certain cases would not apply even to a stock in trade. Now, what had happened here was that the SSE was a dealer in land. They used to purchase land, and thereafter this used to sell the land. The AO made an observation that land is its stock in trade, and in the purchase deed, there were specific schedules of payment which indicated date-wise what were the payments paid. So that contained details including what was the date of payment, what was the mode of payment, what was the amount which had been paid. AO isolated payments of rupees 3,50,000 having been made cash in the total land purchase deal as per from the documents, and said that these payments are subject to 40A3 disallowances because land is your stock in trade. And accordingly made an addition, a disallowance under section 40A3. It was extensively argued that I have not claimed this land in my trading account as an expense. This land has been shown by me as an asset in my balance sheet. And therefore, if there is something which has never been claimed as a deduction, then the question of disallowance does not arise. You can only disallow if I have claimed a deduction, and if I have never claimed a deduction, the question of making a disallowance would not arise. The AO did not accept any of these arguments. The additions were made. Additions were further confirmed also by the CIT appeals. Now, Rule 6DD provides for certain situations where cash payments are permitted. So, Bombay High Court has taken a view that if it is out of commercial expediency, that is irrelevant. You cannot make a cash payment unless it is within the circumstances as laid down under Rule 6DD, and business exigency now does not form a part, and therefore you have to make. Gujarat High Court has taken a contrary view in the case of Anupama Teleservices 366 ITR 122. They still say that business exigency is. Similarly, Rajasthan High Court also says 298 ITR 349 in the case of Harshila Chungradia that yes. So therefore, there was a dispute. Bombay Tribunal said this wise, but in the case of Bombay Tribunal, what was observed by the tribunal, in the case of Bombay High Court, what was observed by the tribunal was that in that case, the SSE was a trader in kerosene, and certain payments for kerosene purchases were made in cash and certain were made in check. So all these kerosene purchases were reflected in his trading account. It was not that deduction had not been claimed. And accordingly, that case came to be distinguished, and the Bombay Tribunal allowed this, and the Pune Tribunal allowed the appeal, holding that no, since there has been no deduction claimed, no disallowance would arise. Now that was the situation. Now this will not be hit by 40A3A also. Let me point out 40A3A. It says that if you have made a payment or you have created a liability, say for instance, I have decided to give commission expenses. So I have debited in my books of accounts commission, and that amount is still payable by me. So that is outstanding in the name of the creditor. In the subsequent years, I make those payments to that creditor of commission expenses, which are in violation of 40A3, then yes, I would be hit by 40A3A, and in those subsequent years where those cash payments have been made against those liabilities, though not claimed in that year, the disallowances would be justifiable. But in this case, what happens is that 40A3 will also not be hit for the simple reason that when I have made these payments, these payments have been directly debited to the asset account, though I treat it as though it is my stock in trade land. So therefore, subsequently, there is no liability for the payment created. So 40A 3A will also not come into place. So that in that manner, one can take an argument that 40A 3 in such peculiar circumstances will not be even hit where the payments are made for stock in trade. One very relevant decision for all of us. We are all professionals and we generally maintain our books of accounts on cash basis. So we recognize income as and when the amount is received by us, irrespective of not when we have generated the bill. In mercantile system, once you raise the bill, you have to recognize the income. In cash system, once you receive that income, only then you have to recognize the income and pay taxes. In this case, a chartered accountant had filed the return of income, and in the return of income, he had claimed TDS in respect of the fees which he had, for which TDS had been deducted in the earlier years. So his TDS claims were for, say, the return was filed for assessment year 14-15, and he had claimed TDS credits for AY 2012-13 and 13-14, stating that I am following cash system of accounting. They have already claimed this expense in the earlier years, deducted the TDS. I have not claimed TDS in those years, but since now when they have given me the check, I am claiming the corresponding TDS. So therefore, though that is 26 years in the current year for 14-15 would not show those credits because those would go in assessment year 12-13, 13-14. The AO took a view that no, I have to strictly follow 26 years. I don't care about what system of accounting you follow. I will not grant you the credit. And accordingly, instead of the refund which was arising to him, he was saddled with a tax liability. He filed a rectification application. Rectification application also came to be rejected. He went to the CIT appeal. CIT said that now this is a technologically driven system and you cannot expect us that every year we match your credits and everything. And this, at the most, what I can do is that if any 14-15 TDS credits have not been granted, I can grant you nothing beyond. On the contrary, he passed an order state wherein he indirectly proposed that I should be following mercantile system of accounting. The matter went to the tribunal. Tribunal, while rendering the decision that no, there is a simple provision whereby you have to give the reconciliation and you have to grant the credit. If you can only ensure, you should only assure that double credits are not granted. But if you are following a particular method of accounting, then accordingly you have to grant. So irrespective of what 26A says, if I am claiming credit of such TDS which has been then credited, whose corresponding income has been received, now I shall be eligible for that TDS credit. And for that, they refer to the decision of the Gujarat High Court in the case of Naresh Bhavani Shah, HUF versus CIT, 396 ITR 589. The case which I am referring of the tribunal is Chirag M. Shah, ITA number 825/AHD/2019. Now, in the base judgment is, of course, Gujarat High Court, Naresh Bhavani Shah, HUF versus CIT. In this case, what had happened was that certain investments were made by the HUF. For some reason or the other, the PAN number of the Karta of the HUF was given. The TDS came to be deducted in the name of the Karta. So therefore, that PAN number and the TDS credits which were granted were in the case of the individual. When the return of the HUF came to be filed, the TDS credit was also claimed. The TDS credit was not granted because 26AS was not revealing, because that had gone into that individual's 26 case. So therefore, this matter traveled right to the High Court. The High Court took the view that no, this cannot be done. They have very elaborately discussed this. They have said that Rule 37BA, there are 3 different conditions. Those three conditions need to be complied with. There can be different situations and you have the right to pass an appropriate order, and subsequent to that, these directions were given. So one can take recourse where there is a 26 years mismatch vis-a-vis when you file your return, when you are following cash system of accounting, and you have received receipts where the corresponding party may have claimed would have deducted TDS in some other years. Another decision which I would like to draw your kind attention is in the case of ACIT versus Sudesh Kumar Gupta, 184 ITD, 651 Jaipur. In this case, what had happened was that a survey operation had taken place in the financial year 2013. The SSE had made a disclosure. The disclosure was in respect of excess stocks which had been found. 20 odd lakh rupees were offered to tax. They were included in the return. Taxes had been paid at the normal rate, and the assessment had also come to be completed. Subsequently, a rectification notice came to be issued. In the rectification notice, the AO said that whatever was your investment for in that excess stock found would constitute unexplained investment, and therefore section 69 would be applicable. Now, once section 69 is applicable, then normal tax provisions would not apply, and the tax provisions as per section 115 BBE would come into play, which are specific sections. Presently, it is from assessment year 17-18, it comes to nearly 78%. In those years, it was 30%, but then no set-offs, no nothing, no, you cannot get the benefit of that differential tax rates also, slabs also, once you cross over the maximum limits. So all those benefits go. This matter was contested before the CIT, and before the CIT, it was explained that I have filed my return. You have examined the return. The amounts which you have proposed have been treated as normal business. You have neither issued me a show cause notice nor called for an explanation why 69 cannot be done. There is nothing on record to demonstrate that after any explanation which has come to be offered, the AO is of the view that the nature and source of investment has not been found to be explained. And where no show cause notice also has come to be issued for proposing to make an addition under section 69, making an application and applying a tax proceedings. Because now there is nothing which demonstrates that there is a mistake apparent from record. Had any of these things been done, had you issued a show cause notice, or you had proposed to make a section 69 addition, and if it had been erroneously left out by you, then it would have been understandable. Since nothing of that sort has happened, you cannot now visit me with 115 BBE and treat this income as unexplained investments. The tribunal also concurred with this view and said that no, in rectification proceedings, you cannot change and now seek to tax the SSE on account of unexplained investments and apply the tax rate under section 115 BBE. The next decision which I would refer to is in the case of Vardhan Girdharial, 138 taxman.com, 101 Delhi. Now, these three decisions which I will now take up would be on demonetization. As you are well aware, firstly, Axon Exports was the first decision in demonetization with respect to cash deposited during that from 8th November onwards. The second decision was Hirapanna Jewellers. The third, now 3 more other decisions have come. One is again Delhi, one is Hyderabad, and one is Bangalore. So in all probability, many of these appeals are pending at the present juncture before the CIT appeals. So I'm referring to all these 3 decisions, though they are on the same issue, but they can help us in our practice And so therefore, I'm taking all the three decisions and bringing it to your notice. The first is Vardhan Girdalian, 138 taxman.com, 101 Delhi. Now, in this case, what had happened was that the SSE was issued a notice under section 142(1) to file the return of income. The SSE filed his return of income, declaring his salary income, his agricultural income, his income from other sources, which was nominal, and some return had been filed of some 3 odd lakh rupees. While completing the assessment, the AO saw that there was 15 lakh rupees deposited in the bank accounts. And these deposits were made in the demonetization period. He was asked, his explanation was sought for, okay, what is the source of this cash which is come to be deposited? The SSE explained that he had made a withdrawal in the month of September from his Kisan credit card, and he placed the evidences. The amount which had been withdrawn was of rupees 15 lakhs itself. The amount which had come to be deposited in the bank account was in the month of November. The AO made an observation that you had withdrawn 15 lakhs by there, and there were 3,000 notes of 500 rupees currency. However, when you have deposited the amount in November, there are 1,600 notes of 500 and 700 notes of 1,000 rupees. So the denominations have changed. So therefore, this is not the same money which you have withdrawn. You must have used your money elsewhere. And now you have brought that money and are seeking to redeposit in your bank account. So that there is a change in denomination. That was the reason, primary reason for making the addition. This matter went to the CIT appeal. CIT appeal said that, okay, I can understand people would hold larger currency, larger denomination notes with a view to it facilitates and eases their entire process. So I will grant you some relief, but that relief is to the extent of 3,50,000. So he did not allow the appeal, but partially allowed it to the extent of 3,50,000. The matter went to the tribunal. Before the tribunal, it was extensively argued that all my sources of income have been identified. You are not finding that any source there is income is not explainable. All sources, whether it is capital gain, my salary income, my agricultural income, my other sources income, all of them are explainable. 2, you are not challenging or disputing the fact that I have made a withdrawal from the Kisan Credit Card Limited, KCC, Kisan Card Credit. 3, you have not brought any material on record or any other evidence on record by which it can be inferred that I have used this money elsewhere. 4th, you have not brought any evidence or other material on record that I have taken some money from other sources to replace the money already spent. Change of denomination, I have choose. It is my choice. I would like to keep it in a particular denomination. Nobody can dictate those terms to me. And all the explanations which have been furnished are plausible, and there is no reason to disbelieve any explanation or submissions which have been made in part. Taking into view this fact, the Honorable Delhi High Court has allowed the appeal of the SSE. So where there is a change in denomination, you may say that my source is XYZ, and even if there is because merely there is a change in denomination, if additions come to be made only on account of the fact that I have made this deposit in the demonetization period, cannot be the reason for visiting the SSE with such huge tax liabilities. So that is one demonetization decision which I have referred to. The second is Anantpura Kalpana, 138 taxman.com, 141 Bangalore Tribunal. Now, in this case, the SSE was a proprietor of a firm, and that firm was trading in BD, in pan masalas, and in tea, drinking tea powder. So all of them are actually FMCGs, those fast-moving consumer goods. And these are sold to various small traders, panwalas and so on and so forth. and groceries, small grocery shops. They make these payments in cash. This cash came to be deposited in my bank account. The AO identified certain deposits made post 8th of November, and said that no, these are not, I will not accept these cash payments. The source is questionable. You cannot trade in these post 8/11, and any deposits which you make post 8/11, I will not accept. And so he made a token addition of 5 lakh rupees. A very interesting argument was made, which I would like to point out, and for which, for some reason or the other, the Bangalore Tribunal has not commented upon, whether adversely or favorably. The argument which was made was that 8/11, the demonetization period started. Till 30th November, I am entitled to deposit old tender. So therefore, that old tender of 500 and 1000 notes is a valid tender till 30th November. Only he argued, the other argument made was that only under section 26(2) of the RBI Act, it provides that the government can specify certain items, certain currency denominations as illegal tender. Now that can be an illegal tender under RBI Act, but that cannot be spilt over and extrapolated under the Income Tax Act. For Income Tax Act, once I'm still eligible to put the money into the bank, it will still be a legal tender. So in fact, this man had made an argument that I can make sales in that old currency even after 8/11, and that is permissible. Now some of the other, this has not been commented adversely or otherwise, but that argument has not been taken adversely. Let me point out. So tomorrow, if you make an argument that I have, even if there is an allegation made that after 8/11 you cannot make this decision, please go through it. It may be able, there might be some assistance or relief which maybe you may be able to seek therefrom. Nevertheless, while deciding the case, the Honorable Tribunal took the view that all those amounts which have come to be deposited from 10th November to 19th November, there are cash sales. Those cash sales are duly reflected in my trading accounts. These are my sale proceeds. The same income cannot be taxed twice, and there is no reason to treat merely those specified banknotes having been deposited in the demonetization period as in edition under section 68. The only source of income is my trade operations, which has not been challenged or disputed, and therefore once you link that cash with your trading operations, which has already been disclosed as sales and whose income has already come to be offered, separate disallowance additions under section 68 would not be permissible. But for this particular reason, which I said, that please look into this. One argument which has been extended in this is that I can make sales even after 8/11 and receive the money in the old currency on those specified banknotes, because till 30th November, I have a right to deposit these amounts in the bank account. So therefore, it cannot be said that it is an illegal tender of money. So that is a very important argument which has been made there. The other addition or the other demonetization case is Latif Abdul Muhammad versus ITO 65 CCH 175 Hyderabad. Here, the additions which have come to be made are in respect of all those deposits which have been made from 8th November, which were amounting to 30 lakh rupees. 10 lakhs of 3 installments were there on different dates. All 3 have been treated as section 68 additions, and additions have come to be made. Here the explanation and what the Hyderabad Tribunal has done is very simple. They said that you go to the SOP. What was the statement of practices which was being done by them? If you recall, from the wing and from everywhere, we had been receiving that big chart. What was your monthly sale from 1/4/2015 to 31/3/2016? What was the total sales? Give the bifurcation of the cash sales within that. What was your sales from 1/4/2015 to 8/11/2015? That is earlier years I'm talking about. What was the cash deposited? Vis-a-vis, you make a comparison with the current year, the year of demonetization. What was your total sales from 1/4/2016 to 31/3/2017? What was the cash deposited during this period? What was the sales from 1/4/2016 to 8 November? What was the cash deposited during this period? Make a comparison. If you are in a position to substantiate that this is my regular trend of business, this is what happens with me normally in the business which has been undertaken, no adverse inference should be drawn. It is not a case that where only in this particular month of November that I have been making cash deposits and cash deposits have not been made earlier. So taking a holistic view in that manner, and the Hyderabad Tribunal has decided this matter in favor of the SSE. So SOP should be taken into account of what has been done, give an analysis of what your cash deposits are. If possible, and if these relate to your sales, explain that these sales, identify those sales, place on record that these sales have been taken into consideration and profits have been already offered to tax. If that be so the position, you will be very on a much stronger footing rather than these additions having been made only on the ground that cash has come to be deposited during the demonetization period. So that is one, the third decision which I was referring to when it comes to demonetization. So for demonetization, once again, I would like to bring to your kind notice. First one is Action Global, which was Delhi High Tribunal, which matter has already traveled to the Delhi High Court, and Delhi High Court has also held in favor of the SSE. The relevant citation, though we are discussing only tribunal decisions, Action Global, the relevant decision is 441 ITR 550. 441 550. And the other decision which I referred to of Hirapanna Jewelers, I'll just give the citation. Just a minute. So these 5 you can keep readily available with you, which can help you. 189,608 Vishakhapatnam. So Hirapanna Jewelers is 189,608 Vishakhapatnam. Action Global is 441 ITR, which I gave the decision, 441 ITR 550, I think. Am I right? If I've, and the 3 decisions which I've referred to now, 5 decisions presently we have on the scene, which are deal with particularly demonetization issue. So moving away from demonetization. Mansukh Bhai K. Wagasia, 138 taxman.com, 84 Surat. Excuse me, I just need. Now, in this case, what had happened was that the SSE was served with a notice under section 148. The AO stated that we have information from the AIR that you have made huge cash deposits of 12.38 lakhs, and therefore the case, there is income escaping assessment to that extent because of the cash having been deposited in the bank account, and therefore such reassessment proceedings have come to be initiated. The appellant had already filed the return, and he had originally also, he was also an income tax SSE. It was not that he was filing the return in response to the notice under section 148 for the first time. The return originally had been filed under section 44 AD. He had explained And in that 44 AD, you are well aware what the provisions are. That in case of eligible SSEs carrying on eligible businesses, if your turnover is less than a specified turnover amount, 40 lakhs, I think it was, now it may have, I don't know if it is changed now, but 40 lakhs at that relevant point of time, then you would be eligible to offer your income at the rate of 8%, but then you will not be eligible for any of the deductions under section 30 to 38. You are not then required to maintain any books of accounts. And if your income is higher than 8%, then you have to disclose a higher income. So primarily these conditions are there for 44 AD. You have to be a specified asset carrying on eligible business. Turnover should be less than specified amount. Income you have to disclose at minimum 8% or higher if you have a higher income, and all other deductions are deemed to have been granted, and you are not required to maintain books of accounts. So he said that I have done all this and I am eligible under section 44 AD. Nobody questioned his right to be under 44 AD, or his eligibility under 44 AD was never questioned. He said that my turnover is 16.52 lakhs. These are my bank statements. There is no other cash deposit. It is less than the turnover which I am disclosing. The return which I am filing is at about 9.5%. So otherwise, if it was 8%, but if there is a higher income, then I am offering higher income, that is also covered. And so therefore, whatever are my turnover, it is out of those turnover, this cash has come to be deposited. The CIT appeal did not accept, but all these arguments which were made that no, this is an explainable cash, and where you are filing your return under section 114, under section 44 AD, and if your cash deposits are less than the turnover, and if you are in a position to substantiate that yes, these are my cash turnovers which I have been able to deposit, because see, the onus would be on the department to prove otherwise. If they say that no, this is not the turnover, then the department has to prove that no, if this is not the turnover, you tell me what else it is. So that would make a very difficult case. You cannot, the department cannot make an allegation without substantiating. So there, if you are in a position to establish that no, this 44 AD return is there and my turnover is in excess of what has been the cash deposited in the bank account, you will be in a probably win-win situation. So this is the decision which I am referring to, because quite a few times we are observing that returns have come to be filed, there are cash deposits, and then on an estimate basis income is being filed. Don't file on estimate basis. File it under 44 AD, try to bring it within the ambit of 44 AB. If you are in a position to establish that yes, that turnover will be exceeding that cash deposited, in most cases you will be able to get away. Rather than making an estimated 50 lakh rupees turnover, ad hoc 2 lakh rupees and job work charges, I file the return. Don't do that. Do job work charges, but go under presumptive tax scheme and see to ensure that that turnover is more than what the cash is deposited. In 99.9% cases, however much the cash, if it is within the limits of 44 AD, you'll be able to get away. What another decision which I would like to refer to is Vijayaben G. Jhalwadia, ITA number 451/AHD/2020. Now, in this case, what had happened was that the SSE filed the return of income. The return of income came to be processed. And after 3 years, the SSE was visited with a notice that you have made repayments of loans in cash, and therefore the provisions of section 269T have been being violated. You are being visited with 271E proceeding, penalty proceedings. Now you are well aware that what those violations are, that if you cannot take a loan from a person in excess of rupees 20,000, or if you have taken a loan, you cannot repay the same back in more than in cash to that same person. To circumvent, because generally these provisions had been brought because formerly in such proceedings, whenever this cash used to be found, people used to explain that I've taken a loan from this person of 5 lakh rupees. in a ચોપડા માં સિલક હોય એટલે everything used to be get managed and the cash would stand display. To circumvent all this, these provisions had been brought into play. Now, in this case, as I pointed out, the return had been filed and it had only been processed. There was no assessment made under section 143(3). The AO, while deciding the appeal, this particular Ahmedabad Tribunal decision, they made a reference to a Punjab and Haryana High Court decision, which is the base judgment, which I'll give you the base judgment, 93taxman.com 156, Punjab and Haryana. What they said was that only a return of income has been filed. This return has come to be processed under 143(1). There is no finding as to the applicability of section 269S or D. It is within the purview of the AO to initiate assessment proceedings by issuing a notice, or in case he can, if he so desires, undertake a reassessment proceedings, but without identifying, without pointing out, no process, only on processing of return, no such penalty can be levied. So this is a very important decision. Please keep in mind that if you have been visited with a 271D or a 271E penalty, and there is no processing, and there is only a processing of return, no assessment order under 143(3) having been filed. Because so many times we are being told that these are, this is 271D proceedings are independent of what your income is. It is only for the violation of a cash transaction, and therefore I don't have to, I'm not concerned with your assessment. Then that would be a fallacious argument on the part of the revenue, keeping in view this decision. You know, this, suppose what happens is, let's slightly get into a different kind of a situation. Suppose I filed my return of income. With my return of income, I have also filed a tax audit report. Now, in my tax audit report is this particular clause which refers to all loans which have been taken by me and paid by me, whether by account check or otherwise. Those have to be specifically stated. Now, in that tax audit report, I have mentioned that no, there is a violation of 269SS, 269D. Then under such circumstances, if such a return which contains a tax audit report, which clearly mentions a violation, whether penalty notices can be issued, because I can always make out an argument that no, my return has only been processed. If my return has not been selected for scrutiny, even if the tax audit report mentions this, can I take refuge of this decision? My humble opinion is yes, you can. So when you are visited with a 271D, 271E proceeding, please first check up whether then assessment has been made under 143, 147 or a 263 consequential assessment. If that being so, you are on a slightly weaker footing, but if it is only a processing of return, yes, you can take refuge of this decision and this can help you. Of course, generally what happens is that if in case of a processing of a return, something, it has been delayed, the penalty proceedings are delayed, because naturally they will not realize it. They will realize it after 3 years, 4 years from audit or from something that, oh, this was missed out, and you are liable for these penalty proceedings. Then you can also take refuge of section 275(1)(c), because those 275(1)(a) and 275(1)(b) deal with, you know, particular timings they have within which the penalty notices have to be issued. 271(c) is a residuary clause where the time frame is very limited. So you will probably get that benefit also. So please look into those angles when you are visited with 271D, 271E penalty proceedings. The next decision which I am referring to is Deepal Suresh Bhai Patel, 62 CCH 30 Ahmedabad. Now, in this case, what had happened was that the SSE had sold a property in the financial year 2013-14. So relevant year would be assessment year 14-15. And in 2015 itself, it had purchased a new property and claimed exemption under section 54. The return was filed, and the return, in that return, exemption came to be claimed. The AO rejected the claim of exemption on this ground, as you are well aware, that you have not invested that amount before, whatever was that uninvested amount in the, you have not deposited the same in the capital gain account scheme. Briefly, I'll tell you what section 54.2 and 54F4, both of them are identically worded. What they say is that if you have transferred any capital asset and any profit has arisen, then you are eligible for an exemption in respect of those profits. In case of a residential house having been transferred, then the capital gain has to be invested in the new house. In case of any other asset, 54F, then the entire consideration has to be invested. Now that they have given a time frame, you have to purchase the new asset before 1 year or 2 years later, within 2 years from the date of transfer of the original asset. Or if you have to construct a house, then it has to be within 3 years from the date of transfer of the asset. So these are the primary conditions. Now they have added up to it is that if there is any consideration which is unutilized, then the same has to be deposited in the bank, in a specified bank account under the title capital gain account scheme account, and that has to be done before the return filed under section 139. So here the AO took the view that you have not deposited this amount and therefore you will not get the benefit. The view taken by the Ahmedabad Tribunal in this case is that the word used is section 139, and therefore 139 embraces all 139. It is not 130, it is not restricted, you were not restricted to 139.1, that is the due date of return. My belated, my revised returns, all those have to be done. 2, so therefore extended date would come into play, and if the investments have come to be made within that specified period, irrespective of you having crossed that specified date for filing the return of income, but overall time limits which have been given 2 years, 3 years, as I explained, then you will be eligible. 2, they said that these are all liberal sections. These are meant for the benefit of the SSE, and therefore these should not be construed in a manner whereby you continuously draw away the benefit from them. No, that is not the intention of the legislature. So please give them the benefit if substantially the entire intention of the scheme has been duly taken into consideration. So therefore, irrespective of you not having made the deposit in the bank account before the due date of filing of the return under section 139.1, if your investments have come to be made within the time limits stated in 54.2 or 54F4, you would still be eligible for the exemption. Deepal Suresh Bhai Patel, 62 CCH 30 Ahmedabad. Now the last 2 decisions which I have kept. The first one is Pabitra Mohan Samal, 181 ITD 391 Cutter. In this case, what I'm trying to draw is a very simple process. You are all aware that once you file an appeal, you can only rely upon such documents which have been presented at the time of assessment. If you intend to file further documents, then you have to make an application for additional evidences. Now, thereafter, they will look into this fact. The CIT has to examine whether I satisfy the conditions under Rule 46A, whether I was deprived of an opportunity, whether I didn't have sufficient time, whether I was intimated at the last moment. All those factors will take cover. And thereafter, the CIT will send the application with the evidences to the AO, call for the remand report, give the remand report to us. We will furnish our rejoinder, and thereafter the matter would be decided. The simple reason is that nobody can be allowed to furnish evidences at any appellate stage without giving it at the original level, because otherwise then everybody would be filing evidences only at the appellate stage and the AO would never be confronted. It's a matter of natural justice, so nothing wrong. Now, in this case, what had happened was that all those evidences had come to be given. There was no separate application made for the additional evidences. And therefore, the CIT said that I will not treat this and not accept these as additional evidences. And he decided the appeal. The matter went before the tribunal. Before the tribunal, the SSC was in a position to demonstrate that no, these evidences had been given before the AO. He referred to the various correspondences made. The additions were primarily made on account of deposits made in the bank accounts. The SSC stated that I was building a house for, say, Mr. X. He deposited all these amounts into my bank account. And from that, I have done the construction work. He got the confirmation and the source from where that man deposited this money. For some reason or the other, they could not appreciate this fact. CIT also, on this simplistic issue that you are giving me these evidences, disregarding this fact that all these evidences had been furnished at the original stage, only on this ground that you are giving me evidences but not the application for admission, dismiss the appeal. The tribunal reversed the decision of the CIT appeal. But here, why I have taken up this decision is that suppose you have filed before the AO, you have not filed. Before CIT appeals, you file the evidences but do not file an application. Then still you will be on a surer footing if you go to the tribunal and say that my evidences have been rejected only because there was not an application not there. At the most, your honors can send it back to the AO for fresh adjudication, and that would lead to the justice of the matter. So that would be a very important decision, that in case you make a mistake, you do not file an application for additional evidences, you should still go to the tribunal and take refuge of this decision. At least this matter will be again set aside back to the file of the AO for fresh adjudication. And Kartikeya bhai, once again, Ruin bhai, thank you so much. My last decision of the day. You have been all very patient and been very kind to accommodate me. I am once again very thankful for this opportunity granted. The last decision which I would refer to is Resolve Salvage and Fire India versus DCIT 139 Taxman.com 196 Mumbai. Now, friends, you are well aware that all interests on taxes 234A, B, C, everything is disallowed. The simple logic is that income tax by itself is not allowable as an expense, and therefore any delay in the payments or shortfalls in the payments also would naturally qualify as an inadmissible expense. But what can happen in a case that where you have deducted TDS, you have delayed the payment of TDS, and now you are liable to pay interest under section 201 bracket capital 1A of the Act. Whether such TDS delayed, interest on delayed deposit of TDS would be an admissible expenditure. Yes, in the above case which I have referred, it has been held that interest under section 201 bracket 1A is an admissible expenditure. The 201(1)(a), it deals with what would be the interest where there is a delay in the deposit. So they have given two different situations. The first is that where TDS was deducted or it was deductible than 1%. Once it has been deducted and thereafter it has been paid 1.5%. In the third circumstances is that where the payee has paid, then from the date to which it has been deducted to where the payee has ultimately paid the tax, though you may not have deducted, you will be liable to pay the interest at 201(1)(a). Now, TDS is your withholding of taxes of a third person. Suppose there is a commission payment you have to make. So on that commission payment at a predefined rate, you have to deduct TDS. You deduct that TDS, but you don't pay the TDS, deposit the TDS with the government treasury on time. So for that delay, you are paying the TDS, but that is a compensatory nature interest which you are paying. This is not a penal interest. It is in respect of income tax of a third person and therefore would be allowable as a deduction. So in case of a delayed interest on TDS deductions, the claim can be made for a deduction and you will not be hit in any manner whatsoever. So once again, I thank you for this patient hearing, and I'm greatly obliged and I thoroughly enjoyed this session. Thanks once again for inviting me.
Respected sir, now our account is clear, because without your speech, I don't want to end this year. So thank you so much for accepting our invitation once again. But the matter of the fact is that many senior chartered accountants and advocates has joined to hear you, and we always like to hear you on the litigation side. So that's why, sir, I emphasize. I am extremely sorry again that I heard the news, and I am extremely sorry for the loss. Really. But sir, we want to hear from you. So that was the insistence. Now I request Honorable Treasurer C.A. Sivam Bhavsar to please give certificate of appreciation to our Honorable Authority. Sir, please accept this certificate of appreciation.
Thank you so much. Thank you.
For the time you have given, for the knowledge you shared with our members. Thank you so much.
It has been my pleasure, and it is my duty. And you both, father and son, are doing a tremendous job. And we are only putting a small effort in this. So the credit actually goes to you organizers for this.
Oblige, sir, oblige. And finally, sir, this is the time to say goodbye, and this is emotional moment for me, because since 1 year I have tried my best, and my the whole managing committee has tried their best to give this federation a new height. So this is the last webinar, but the new president is also energetic, and he will come with many more webinars. So sir, please always support AGFTC as you have supported. And with these words, we are ending this webinar. Please all come to annual general meeting, which is on 2nd July, 6:30 p.m. at Grand Prix Banquet. Please spare time for the AGM of AGFTC. Sir, we are also inviting you to please come. You are a respected member of AGFTC. Thank you so much, sir. We are ending this webinar. Thank you.
Thank you.
Thank you, Aseem bhai.
Thank you, Bakul bhai.